You guys recognize this gentleman here?
Yeah. Tony Robbins.
Tony Robbins. He's not coming today. You get me, okay? We're gonna walk over coals, okay? I'm gonna bring out some fire coals and we're gonna walk over.
I like the glass.
No, he actually, obviously he's a motivational speaker, coach, and so forth, but he works a lot with a lot of rich people, rich clients. And I guess some time ago, he started getting interested in financial literacy and started asking his clients and started doing research. And after years of research, he came to some interesting conclusions that are going to support us and actually support this whole case against mutual funds. And at this point, I knew a little bit about this, but one of my partners, he's an advisor in our office, he just took the ball running. He ordered the book, he studied it, and he did a presentation, and I learned so much from him reading this stuff and passing it on to me, just knowing that Anthony Robbins has done his own research that's going to help you. So I'm going to invite Mr. Nicholas Javier up. So if you guys don't mind giving him your undivided attention, you're welcome. He's going to talk about what Anthony Robbins is saying in his book. So let me get this going. So just tell.
Hi, everybody. I'm Nick. I've been with Alvin since the beginning. Alvin's been great. He's been a mentor to me, a friend. I've learned so much in the industry to the credit of Alvin. Bulk of what I do, I'm in Orange County. My office is in Orange County. Bulk of what I do is basically I have partnerships with CPAs, tax preparers that refer me lots of business, and their growing excitement is for what's coming with the 401k stuff. So I'm pretty psyched about what's ahead. So I'm going to go over a couple of the 9 financial myths that I read about in the book. I mean, some pretty powerful stuff.
What's the name of the book, Nick?
It's Money Master the Game. If you guys want to check it out, I recommend it. Okay, so myth 1, invest with us will beat the market. This is called the $13 trillion lie. An incredible 96% of actively managed mutual funds fail to beat the market over any sustained period of time. That's pretty powerful numbers. That means basically you have a 4% chance of picking the right mutual fund. Those of you like blackjack, anybody? If you go to Vegas and play blackjack and you have 2 face cards, you have an 8% chance of getting the ace to hit 21. You have better odds in Vegas, in my opinion. Just how badly does chasing performance hurt us? Over a 20-year period, December 31st, 1993 through December 31st, 2013, the S&P returned an annual average of 9.28%. The average mutual fund investor made just over 2.54%. That has to do with fees. That has to do with underlying costs they don't disclose. Also market performance. That's an 80% difference. Myth 2 are fees. They're a small price to pay. The mutual fund industry is now the world's largest skimming operation, $7 trillion from which fund managers, brokers, and other insiders are steadily siphoning off an excessive slice of the nation's household, college, and retirement savings. That's from Senator Peter Fitzgerald. The best way to explain mutual funds to people, basically, is you give me your money as the advisor. You tell them, okay, you're going to give me your money and you're taking all the risk, okay? I'm going to invest your money, and if it goes up, great, you win. And I win too. But if it goes down, I win, but you lose. It's the best possible way to explain mutual funds in a nutshell. Put that up there. It says you put up the capital, you took all the risk, and they made no money, their money no matter what happened. This is continued. The average cost of owning a mutual fund, as Alvin covered before, is 3.17% per year. Alvin had a chart earlier. This just shows the impact on basically fictitious endings. Jason, Matthew, and Taylor both at $100,000 at 7%. You can see the difference: 3%, 2%, 1%. The numbers are obviously pretty powerful. Yeah, absolutely. Let's see how far this goes. Does this go far? Can you guys see? Okay. Yeah. So I mean, the numbers speak for themselves. Our returns, what you see is what you get. Surprise, the returns reported by mutual funds aren't actually earned by the investors. Jack Bogle, he's a founder of Bogard. Because the returns you see in the brochure are known as time-weighted returns. Okay, time-weighted returns assume that investors have all their money in the fund the entire year and don't take withdrawals, but reality is we typically make contributions throughout the year. If we contribute more during the time of year where the fund is performing well and less when it's not performing, we're going to have a much different return than what was advised. Typically, if the fund averages or advertises 6% return, its investor really achieve closer to 3%.
Hi, this is Alvin Parr, and thanks for watching. If you want more information on the GreenLine 401k, click on the link on this video.